Hello, and welcome to Understanding Binary Options, Part 3, titled Parallelizing Trades Across Multiple Related Indices, which is Part 3 of this video series. It's a slightly longer title, but it's actually a fairly straightforward concept, and therefore it'll be a relatively shorter video. So let's get right into it. Let's overview what binary option trading basically is. We pick a commodity or currency or stock, and each of these has a current value at any given point in time. And binary option trading relies on our ability to predict what the value is going to be sometime in the future. We call if we think the value is going to go up, and we put if we think the value is going to go down. Being right gets us a percentage of what we put in, but being wrong means we lose all of what we invested. And this is overviewed in detail in part 1 of the series, which focuses on binary option trading from the perspective of a beginner. Part 2 of our series dealt with a basic strategy where we don't think of each trade as independent of the other, and essentially if we make a bad trade, we try and use the information learned to make the next trade a little bit smarter. It's based on the principle that no stock or index can rise or fall indefinitely, and if we pick any direction, regardless of whether it's put or call, and we stick with that direction, eventually we should be correct. And then whenever we are correct, we try and offset the losses that we've made from earlier bad trades with this one correct trade. And this is covered in detail in part 2 of our series. So this particular video, part 3, focuses on one aspect in particular where we don't think of each trade as independent of the other. So let's get right into it. Let's say we focus on any particular index. Consider it for the sake of example to be the US dollar to the Japanese yen. Now if the value of this index is rising, it could be for a number of different reasons. Either the US dollar is growing in value while the Japanese yen is relatively still or not growing as fast, or perhaps the Japanese yen is falling in value while the US dollar is relatively still or not falling as fast as the Japanese yen, or it's a combination of the above. Now, especially in the case of the first two reasons, it's important to note that this trend is also going to be most likely the case for other related indices. And what are other related indices? They're indices that either involve the US dollar or the Japanese yen. And we'll see what we exactly mean by this in just a second. Now let's say we're focusing on multiple indices at a time. Again, let's continue our previous example of the US dollar to the Japanese yen. Let's first take the case where the US dollar is growing in value while the Japanese yen is relatively still. Supposing we looked at other indices involving the US dollar, such as the US dollar to the euro or the US dollar to the Canadian dollar. Now let's say the euro is also relatively still, then the US dollar to the euro is actually expected to go up because the US dollar is growing in value. At the same time, if the Canadian dollar is also relatively still, then the US dollar to the Canadian dollar is also expected to go up. Now let's suppose it was the other direction. Supposing the Japanese yen is actually falling in value and it's not the US dollar that's growing in value, then supposing we pick other indices involving the Japanese yen, such as the euro to the Japanese yen or the Canadian dollar to the Japanese yen, if the euro is also relatively still, then the value of the euro to the Japanese yen is expected to go up, because even if the euro is not growing up, the Japanese yen is falling. And by the same token, if the Canadian dollar is also relatively still, then the value of the Canadian dollar to the Japanese yen is also expected to go up. And essentially, we leverage the knowledge from one index to make a smarter trade on a related index, because we realize that trades need not necessarily be independent. Therefore, what we're trying to do is trade across not just one index at a time, but in parallel. So we trade not just with the US dollar to the euro or the US dollar to the Canadian dollar. We also may trade with other indices, the US dollar to something else. But of course, with any such strategy, we need to be careful. So what do we need to be careful about? We have to understand the reasons for an index to go up. It's important to be sure that if the US dollar to the Japanese yen is actually growing, why is it growing? We need to be sure that it must be for one of the reasons we pointed out, like the US dollar is actually growing in value. How do we do that? We take some time and we observe the index. We take maybe 30 minutes to an hour or even longer if possible and try and observe the trends. And we also look up on related indices. For example, if the US dollar is genuinely growing in value, like we discussed in just a minute ago, we should be able to see this in other indices as well. It's also important to note that parallelizing one's money across multiple trades at the same time, across not just the US dollar and Japanese yen, but also the US dollar and to the euro, if we parallelize these trades, it means that when we're right, we gain quite a bit, but if we're wrong, we also lose on all of these trades. It means our money gets depleted faster, and this is particularly relevant if we're following the strategy outlined in part 2 of the series, which meant we stick with one direction, either putting or calling, for slightly longer lengths of time, in which case we need our cash reserves to hold. We can't just lose them quickly. Also, timing is critical. No index is going to indefinitely keep on rising or falling, and in order to be successful, we need to be in the middle of this trend. We need to be either while it is rising or while it is falling. We can't be at that point where it was falling and now it's suddenly going to rise, and we came in at just that point in time. This has a lot to do with the point of inflection, which is a concept we'll get into in our subsequent videos. But suffice it to say that these are very important considerations to take into account for such trading. At any rate, the parallelizing strategies hasn't actually turned out to be a bad strategy for me personally. About 70% of the time I have been right, and it's helped me make back some of the money that I've lost from the very beginning. I go into details in this at the end of part 1 of the video. But at any rate, it's not a bad strategy, but we do need to be careful. So I think that concludes this particular video. Thank you for your time. Happy trading, and as always, be careful and take your time, understand the concepts really well. And if you find this video to be helpful, please like or leave comments. And at the same token, if you do see room for improvements, make sure to say that in the comments as well. Thank you very much. Goodbye.